Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. The Fed watch, the waiting game continues. Well, unsurprisingly, the Fed did what was widely expected yet again and kept the Fed funds target unchanged at the March FOMC meeting. So as a result, the trading range stays at 5.25% to 5.5%. which still resides at a more than 20-year high watermark. And for those keeping track, this represented the fifth consecutive Fed meeting where the policymakers decided to take no action on the rate front. And while Powell and company all seem to be on the same page that a rate cut will more than likely occur sometime later this year, the important point, or maybe I should say the next point to consider, would then be when will this potential easing move occur? And more importantly, what will the rate cutting episode eventually look like? I've mentioned in prior blog posts, there had been a disconnect between what the money and bond markets were expecting in terms of rate cuts and what the Fed was thinking about on that front. And heading into this year, this meeting, this March Fed meeting, which just concluded, was viewed by the markets as the time frame for when the first in a series of about 6 rate cuts would begin to occur in 2024. Well, that's a moot point now, isn't it? I mean, the good news is that the Treasury arena and the other money markets and other bond markets have now come closer to the Fed's expectations for only 3 rate cuts this year, at least as I'm talking to you today, with June becoming the new March for the initial cut. Now, certainly the labor market and inflation data have thus far been providing the Fed with no urgency to consider easing monetary policy anytime sooner than June. In fact, recent reports for employment and CPI, PPI could arguably call a June liftoff into question if the data continue to come in like this. So as a result, the voting members apparently feel they can just sit back and be patient right now. Matter of fact, if you look at the Fed funds median estimate for next year, the Fed actually bumped that up a little bit. So there is, once again, I think some debate going on with the Fed about this rate cut and what it's going to look like as we move forward. But looking ahead, I think Chairman Powell, did he at least offer us any clues as to what he's thinking about regarding the timing for rate cuts at his recent semi-annual monetary policy testimonies before Congress? Interestingly, Powell stated the Fed is, quote unquote, not far from confidence to begin cutting rates and that inflation doesn't have to get all the way down to the Fed's 2% target to do so. But what does that mean exactly? In my opinion, continued progress on inflation will determine whether a June rate cut remains the starting point. And while the Treasury market is laser focused on the CPI data for inflation, the Fed's 2% target is based on its preferred measure, the core PCE, which presently is at an annualized increase of 2.8%. So let's take Powell at his word. So one has to wonder if, say, we get core PCE down to 2.5%, will the real Fed inflation target be 2.5%? And this is where things could get tricky, because that could willy-nilly mean that core CPI may still be at a rather elevated, say, 3 to 3.5%. And would the Fed really cut rates if core CPI was that high? Let's also not forget quantitative tightening, QT. The Fed's balance sheet's plans are now coming into view, and an imminent end to QT does not appear to be on the table just yet. But reducing the pace of its balance sheet runoff looks like it will become part of the monetary landscape later this year as well. The bottom line is, what should investors look for in terms of monetary policy going forward? If history's any guide, the Fed's not just going to begin cutting rates with any guidance on that front. So if the Fed is going to begin easing rates in June, that puts the onus on the May FOMC meeting to begin the process of this guidance. Alrighty, I'm going to end it there. I hope everyone has a great rest of the week and be well.